If you spent your career as a teacher in certain states, or as a firefighter in a non-Social Security jurisdiction, or as a state or local government employee who did not pay into the federal Social Security system, you may have encountered a rule called the government pension offset. And if you are the spouse or surviving spouse of such a worker, there is a parallel rule that may have reduced your own Social Security benefit by 2/3 of your government pension. That is the reduction. 66 cents of every dollar you receive from your government pension is subtracted from the Social Security spousal or survivor benefit you would otherwise receive. For many retirees, that subtraction eliminates the spousal benefit entirely. Decades of marriage to a covered worker, thousands of dollars in expected spousal benefits, reduced to zero by a rule most Americans have never heard of. There has been recent legislative activity around this rule, and the landscape is actively evolving as of 2026. But for the retirees currently affected, and those who will be affected in the coming years, the government pension offset is quietly one of the most consequential provisions in Social Security law. If you are a government retiree or married to one, you need to understand exactly how this rule works, what recent changes have been made, and what strategies are available. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. The rules around the government pension offset and the related windfall elimination provision have been the subject of recent legislation, and the Social Security Administration's implementation of any changes is ongoing. Always verify the current status of these rules with the Social Security Administration directly, either through your local field office or at the official website, before making decisions based on them. Let me start with the basic structure of the government pension offset, which I will refer to as GPO from here on. The GPO applies when a person receives a pension from a job in which they did not pay Social Security taxes, commonly called non-covered employment, and then seeks to claim a spousal benefit or a survivor benefit on their spouse's Social Security record. Under the GPO, the spousal or survivor benefit is reduced by 2/3 of the non-covered pension. If the 2/3 reduction exceeds the spousal or survivor benefit, the benefit is eliminated entirely. Consider Dorothy. She spent 35 years as a public school teacher in Texas, a state where many school districts do not participate in Social Security. Her Texas Teacher Retirement System pension, as of 2026, pays her about $3,600 a month, or $43,200 a year. Her husband Harold, a retired postal worker, earned substantial Social Security credits over his career and receives a monthly benefit of about $3,000. Dorothy, as Harold's spouse, would ordinarily be entitled to a spousal benefit of up to half of Harold's benefit, or about $1,500 a month, if she claimed at her full retirement age. But the GPO applies. 2/3 of Dorothy's $3,600 monthly pension is $2,400. Since that amount exceeds the $1,500 spousal benefit, Dorothy's spousal benefit is eliminated entirely. She receives zero from Social Security as a spouse, even though she was married to Harold for 40 years, and he paid into Social Security throughout his career. This is the heart of the GPO. It was enacted in 1977 to address what Congress viewed as a fairness issue. The idea that government retirees without Social Security contributions should not receive spousal benefits based purely on their spouse's work history. Supporters of the rule argue it prevents a form of double dipping. Opponents argue it unfairly penalizes workers who chose public service in non-covered jurisdictions. The debate has been live for decades, with periodic legislative proposals to repeal or modify the GPO, and there has been significant recent activity on this front. In late 2024 and into 2025, Congress passed legislation known as the Social Security Fairness Act, which repealed both the GPO and the related windfall elimination provision, or WEP. The implementation of this repeal has been rolling out through 2025 and into 2026, with the Social Security Administration retroactively applying the changes to affected beneficiaries. The details of the implementation, including the timing of benefit adjustments and any retroactive payments, have been ongoing. If you are affected by the GPO or WEP, the situation in 2026 may be different from what it was in 2023 or earlier. You should contact the Social Security Administration directly to understand your specific status and any adjustments that may be pending for you. For the purposes of this video, I want to explain how the GPO historically worked, because many retirees are still processing its effects and trying to understand whether the recent legislation applies to them, and because similar rules may be proposed in the future as the Social Security system addresses its funding challenges. Even with the recent repeal, the lessons about non-covered pensions, spousal benefits, and the interaction between different retirement income streams remain important. So let me walk through the mechanics in more detail. The GPO applied to spousal benefits and survivor benefits, but not to retirement benefits based on the individual's own Social Security work record. If Dorothy had worked outside of teaching for enough years to earn her own Social Security benefit, that benefit would not be reduced by the GPO. Only the spousal or survivor benefit was affected. This created planning opportunities for government workers who could supplement their non-covered careers with side work or second careers in Social Security covered employment. 40 quarters, or 10 years, of covered employment is the minimum required to qualify for your own retirement benefit. Consider Ruth. She taught in Louisiana for 28 years, which did not participate in Social Security. After retiring, she worked for another 10 years as a consultant, earning Social Security credits. Her own retirement benefit, earned through those 10 consultant years, is modest, about $800 a month. The windfall elimination provision, before its recent repeal, reduced that benefit because she had a non-covered pension, but her own retirement benefit was still hers and not affected by the GPO. Her spousal benefit on her husband's record, however, was fully affected by the GPO as it existed before the recent legislation. The recent Social Security Fairness Act changes the landscape for people like Ruth and Dorothy substantially. Ruth's own benefit will no longer be reduced by the WEP, and Dorothy's spousal and survivor benefits will no longer be reduced by the GPO, subject to the implementation timeline. Affected beneficiaries may receive retroactive payments covering the period from the effective date of the new law. The exact amount of those retroactive payments and the timing of their receipt depends on the SSA's implementation schedule. Even with the repeal, several practical issues remain important for retirees to understand. First, the benefit amounts that will now be paid to previously affected retirees are not automatically calculated and deposited. The SSA must process each affected record individually, and the processing timeline has been extended in some cases. If you were previously receiving a reduced benefit due to GPO or WEP, you should monitor your SSA account and expect your new benefit amount to be implemented over the coming months. Delays are normal given the number of affected records. Second, the change in benefits may have tax implications. A retroactive payment covering multiple years could push your income into a higher tax bracket for the year it is received. There are specific rules for allocating retroactive Social Security payments across the years they apply to, which may reduce the tax impact. This is a situation where a tax professional can help you manage the reporting to minimize the tax consequences. Third, the increase in benefits may affect your IRMEA calculation 2 years later. A significant retroactive payment could push your modified adjusted gross income above an ERMEA threshold, triggering higher Medicare premiums. If this applies to you, you may be able to use Form SSA 44 to request an adjustment based on the one-time nature of the increase, depending on whether the SSA treats it as a qualifying life-changing event. Fourth, if you had made financial decisions based on the expectation of reduced spousal benefits, you may now have more income than you planned for. This is a good problem to have, but it still requires planning. Consider how the additional income affects your tax bracket, your state tax situation if you live in a state that taxes Social Security, your eligibility for any income-based programs, and your overall retirement cash flow. Now let me address retirees who are planning for future benefits and who work in or are married to workers in non-covered employment. Even with the recent repeal, the broader landscape of non-covered pensions and Social Security is complex. The repeal itself could be modified in future legislation, particularly if Congress revisits Social Security funding. Planning for these benefits requires both knowledge of the current rules and awareness that rules can change. If you are currently working in a non-covered government job, understand that your pension from that job will interact with Social Security differently than a private sector 401k or pension. Check with your retirement system to understand exactly how your pension will be treated. Ask specifically whether your pension is covered by Social Security or not, because some public employers do participate in Social Security and some do not. If you are married to someone in non-covered employment, understand that Social Security survivor benefits have their own rules that interact with the GPO and related provisions. A surviving spouse of a worker who had a non-covered pension and a Social Security record can face complex benefit calculations. The recent repeal simplifies this in many cases, but not all, and individual circumstances matter. Let me introduce another persona, Frank and Beatrice. Frank was a firefighter in a city whose pension system did not participate in Social Security. He passed away at 68 in 2023. Beatrice, a retired librarian, had her own Social Security benefit and would have been entitled to a survivor benefit on Frank's record from the Social Security system. If Frank had earned Social Security credits through a side career, Frank had indeed worked summers as a carpenter in his younger years and earned 40 quarters of Social Security coverage. Under the pre-repeal rules, Beatrice's survivor benefit on Frank's record would have been reduced by 2/3 of her own librarian pension, which was a non-covered pension. After the repeal, Beatrice may now be entitled to the full survivor benefit on Frank's record, subject to SSA implementation. Her income in 2026 could be meaningfully higher than it was in 2023, and she needs to update her tax planning accordingly. The broader point is that benefits owed to a surviving spouse after the death of a covered worker, when the survivor also has a non-covered pension, are one of the most complex and high-stakes areas of Social Security law. Always work with the Social Security Administration directly to understand exactly what you are entitled to. The administration has been directed to implement the recent changes, but the complexity of individual records means that automated adjustments are not always complete or correct. You may need to proactively contact the SSA to make sure your benefit reflects the current law. Here are some specific steps to take if you think you may be affected. First, if you or your spouse have a pension from a job that did not pay Social Security taxes, pull out your recent Social Security statements. Check whether your statement reflects any GPO or WEP reduction. The SSA should be updating statements to reflect the new law, but the update may not be immediate. If your statement still shows a reduction, contact the SSA to ask about the timeline for adjustment. Second, create a My Social Security account online if you have not already. This is the fastest way to check your benefit status and expected payments. Third, review your tax withholding on Social Security. If your benefit is increasing as a result of the repeal, your current withholding on Form W-4V may be insufficient, and you could face an unexpected tax bill. Adjust withholding proactively. Fourth, if you receive a retroactive payment, understand the tax treatment. A lump sum covering multiple years can have different treatment than a current year payment. A tax professional can walk you through the options. Fifth, monitor any additional legislation. The political and legal landscape around Social Security continues to evolve, and future changes could affect benefits again. Let me cover a few specific traps that affected retirees have historically faced, and that some retirees may still face during this transition period. Trap number 1. Assuming that, because you never paid into Social Security, you are not entitled to any benefits on your spouse's record. Under the old rules, the GPO could reduce or eliminate spousal benefits. Under the new rules, those benefits may be restored. Do not assume. Check with the SSA. Trap number 2. Delaying a claim for spousal or survivor benefits because you assumed you would not receive anything. If you are now entitled to benefits under the repeal, claim as soon as you are eligible. The SSA will process claims based on the current law. Trap number 3. Failing to update your financial plan when benefits change. An increase in Social Security income may affect the optimal mix of withdrawals from your IRA, 401k, Roth, and taxable accounts. Rebalance your withdrawal strategy if your benefit amount is changing meaningfully. Trap number 4. Not coordinating with your spouse's claiming strategy. If your spouse is still working or is not yet claimed, the timing of their claim can affect your eventual survivor benefit. Claiming strategies for couples where one spouse has a non-covered pension require careful analysis. Trap number 5. Overlooking state-level rules. Some states have their own retirement benefit provisions that interact with Social Security. If you worked in one of the non-covered states, check whether your state retirement system provides any supplemental benefits or coordinated benefit calculations. Trap number 6. Failing to document your work history. Workers who had multiple employers over a long career sometimes have incomplete Social Security earnings records. Missing earnings can reduce your eventual benefit. Review your earnings record carefully and correct any errors by submitting documentation to the SSA. The broader lesson for retirees affected by non-covered pensions is that Social Security rules are not static and can be changed by Congress in meaningful ways. The recent Social Security Fairness Act is a significant example of legislative change that benefited a specific category of retirees. Similar changes could occur in the future in other areas. Staying informed about the rules that affect you and being willing to advocate for your rights when the rules are changed in your favor is part of the work of managing retirement income. The SSA will not always come to you proactively. Sometimes you need to go to them. For retirees who were negatively affected by the GPO and WEP before the recent repeal, the current moment is an opportunity to ensure that benefits are correctly calculated going forward and that any retroactive payments owed are received. For retirees who are not directly affected but who know someone who is, a well-placed conversation can help a friend or family member understand their new rights. Many of the affected retirees are in their 70s, 80s, or 90s, and navigating the SSA to claim new benefits can be difficult without help. Let me add a practical section on documenting your work history for the SSA. Many retirees who worked in non-covered employment had secondary or side jobs that generated Social Security credits over the years. summer work, consulting gigs, part-time retail, self-employment income reported on Schedule SE. Each of those activities may have generated quarters of coverage toward the 40 quarters needed to qualify for your own Social Security benefit. If your earnings record with the SSA is incomplete, you may be entitled to a higher benefit than currently shown. To check your earnings record, log into your My Social Security account online and review the year-by-year earnings history. If you see a year where your earnings should have been higher than what is reported, gather documentation such as old W-2 forms, tax returns, or pay stubs, and submit a correction request to the SSA. Corrections can be made at any time, and adding missed quarters of coverage can make the difference between qualifying for your own benefit and not qualifying. For retirees affected by the recent repeal of the GPO and WEP, this is an especially important step, because your own benefit amount depends on the accuracy of your earnings record. If you want to learn more about Social Security strategies, claiming decisions, and how different pension types interact with federal benefits, I cover these topics in other videos on this channel. The full picture of retirement income planning requires integration across multiple systems, and Social Security is only one piece. But for retirees affected by the GPO, this piece has just grown considerably. Take the time to check your status, update your records, and make sure you are receiving the benefits you are entitled to under current law. The rules have changed in your favor. Do not let a paperwork gap keep you from the benefit Congress intended for you to receive. Take care of the details, and the bigger picture takes care of itself.